Most people look at the stock market when they want to measure danger. I have spent most of my life looking somewhere else. First, I look at the thing people use to buy the stocks. That sounds simple, but it is where investors get trapped. They stare at the trophy on the shelf and ignore the ladder they climb to reach it. They talk about valuations, momentum, earnings revisions, artificial intelligence, soft landings, hard landings, election cycles, and every other idea that can fill airtime. Meanwhile, the real stress begins underneath the whole structure, in the financing leg, in the currency leg, in the assumption that the money used to fund risk will stay cheap, loose, and weak. That is why this setup matters so much. The biggest danger in this document is not merely that stocks have gone too high, or that oil has become nervous, or that central bankers may disappoint somebody next week. The danger is that a great many people have built positions on the same assumption at the same time. They have acted as if the dollar could only get softer, as if the financing currency would stay friendly, as if they could stay long risk and short dollars without paying a price for it. Retail investors have done it in their own way. Institutions have done it in bigger size. Hedge funds have done it with leverage. Commercial players have done it because the trade became normal. Once a trade becomes normal, people stop treating it like risk and start treating it like plumbing. That is when the trouble usually begins. I have seen that pattern more times than I can count. People rarely lose the most money on the trade they know is speculative. They lose it on the trade they have begun to call obvious. They lose it where confidence becomes routine. They lose it where the whole crowd starts to believe that the opposite side of the trade no longer exists. When that happens, the market does not need a dramatic new idea to reverse. It only needs a small change in conditions and a large imbalance in positioning. That is what this transcript is really describing. It is describing a market that has used a weak dollar as the easy leg of a much larger bet. Short the dollar, buy equities, lean into risk, assume Europe will hold together well enough, assume central banks will glide into cuts when growth slows, assume energy pressure is temporary, assume the dollar may wobble from time to time, but assume it will not become a problem. If those assumptions stay intact, people can ride that structure for a while. If those assumptions start to fail together, they do not get a gentle adjustment. They get an unwind. And an unwind is different from a disagreement. A disagreement allows you to think, an unwind forces you to act. When people are short a currency, and that currency begins to rise, they do not have the luxury of a long philosophical debate. They have to buy it back. To buy it back, they often have to sell whatever they bought with the proceeds of that short. If enough people are crowded into the same structure, the act of reversing the trade pushes the reversal further. Selling creates more need to cover. Covering creates more pressure on the very currency people bet against. Then the crowd discovers that what looked liquid on the way in becomes narrow on the way out. That is why a move in the dollar can matter more than the average investor appreciates. This piece keeps returning to the DXY, the dollar index, and that is sensible because the chart is not just a picture of price, it is a picture of habit. The dollar kept falling into an area where buyers stepped in. Then it kept rising into a zone where sellers leaned on it again. Over time, that behavior teaches people something. It teaches them that shorting the dollar on strength is safe. It teaches them that rallies are temporary. It teaches them that they can wait for the move up, fade it, and move on. The market trains people before it punishes them. If that repeated pattern now breaks, then every person trained by it is suddenly leaning the wrong way. The transcript talks about a move toward 102, then 104, and beyond that perhaps even 110. Whether those exact numbers arrive in one motion or several is not the most important point. The important point is the direction of stress. Once a range that has invited repeated shorting begins to give way, the problem is no longer theoretical. The problem becomes mechanical. Traders who sold dollars because it always worked are now covering because the chart no longer respects the old habit. I do not need the last decimal point to understand the implication. I only need to know what kind of people are trapped, what they own on the other side, and what they are likely to do next. The other side of this trade is where the story gets dangerous for stocks. The transcript overlays the dollar and the S&P 500 for a reason. When the dollar weakened, equities had room to rally. When the dollar surged, equities stumbled. Not every dip in the stock market came from the dollar alone. And not every dollar bounce produced a crisis, but the relationship matters because it reveals how much the risk trade has leaned on dollar weakness. If investors have been using a soft dollar as the friendly background for long equity exposure, then a stronger dollar is not just a currency event. It is a tightening event. It is a de-risking event. It is a pressure event. That is what people miss when they talk about the dollar, as if it were merely a macro sideshow. It is not a sideshow when it is the funding leg. If the short dollar trade is as crowded as this piece argues, then the market is more fragile than it looks on the surface. Stocks may still be holding together in headline terms. Commentators may still be debating whether a correction will be mild or moderate. But underneath the surface, institutions may already be changing their posture. That is why the references to JP Morgan, State Street, Bank of America, Goldman, and the futures positioning matter. The names themselves are not magic. The message is positioning has begun to shift. Speculators have already cut a meaningful portion of their anti-dollar bets. Institutional investors have shown stronger moves toward safety. Asset managers have reportedly been slashing SP futures exposure. Record selling in notional terms is not the sort of thing I ignore. I never assume that a crowd has fully exited just because it has started to move. Large institutions do not turn an aircraft carrier in 1 second. They begin by trimming, then they hedge, then they sell what they can, then they sell what they must. Then the public, which was looking at old prices and old narratives, discovers that leadership has already changed. That is why late-stage reversals feel so unfair to people who arrive late. The tape still looks survivable until suddenly it does not. There is another important idea in this source, and it is the twist behind the dollar move. The dollar is not rising in a vacuum. It is rising partly because the euro is vulnerable. And the euro matters enormously to the index. Many investors hear the phrase dollar index and imagine some broad, abstract scorecard of global confidence. In practice, the euro carries a very large weight in that basket. So when the euro weakens for structural reasons, the dollar can strengthen sharply, even if the United States is hardly in perfect health itself. That is why oil becomes central to the argument. Energy hits Europe differently. A high energy bill is a nuisance for a strong importer and a real wound for a fragile one. The Eurozone is deeply exposed to imported energy. When oil and related energy costs climb, trade balances worsen, margins get squeezed, households feel it, and the currency pays a price. The transcript is clear on this point, and I think it is one of the strongest pieces of the whole document. The dollar may be the thing flashing on the screen, but the pressure starts with energy and flows through Europe into the euro and then into dollar strength. That is a much more interesting story than simply saying the dollar is having a good week. It is a story about where the world is weak. It is also a story about what investors thought central banks would do. The market had grown comfortable with a certain policy arrangement. The Federal Reserve was expected to cut rates. The European Central Bank, facing its own inflation pressures, was expected by some to sound relatively firmer. That combination supported the logic of betting against the dollar and in favor of the euro, or at least against the idea of a major dollar squeeze. But now the assumptions have begun to shift. If the Fed stays on hold longer than the market wanted, and if energy-driven uncertainty makes the ECB less willing or less able to maintain the hawkish tone that traders hope for, then the trade changes. The euro loses a pillar of support, the dollar gains one. A crowded short becomes even more vulnerable. I have always believed that markets get most dangerous when people are relying on a chain of assumptions rather than one assumption. One assumption can fail and still leave room to adjust. A chain of assumptions fails all at once. Here the chain looks something like this. Energy remains manageable. Europe remains stable enough. The ECB can stay hawkish enough. The Fed cuts enough. The dollar stays tame enough. Stocks stay elevated enough. The crowd has time enough. That is too many enoughs for my taste. This source also makes a point that many people have trouble holding in their heads at the same time. Higher energy prices can create a burst of inflation pressure, but that does not mean they create durable prosperity or durable inflation. In fact, when wages and hours are not keeping pace, higher energy often acts more like a tax on an already strained consumer. It squeezes spending power. It hurts demand elsewhere. It slows the real economy. The transcript links rising gasoline prices with temporary movement in CPI and then with eventual economic weakness. That fits with a pattern investors have seen many times. Energy spikes can arrive before recessions and before larger financial accidents, not because they create healthy growth, but because they strain a system that cannot absorb them cleanly. That is why I do not take comfort from the simple statement that higher oil means inflation, and inflation means stronger nominal growth. Real life is messier than that. A consumer does not become wealthier because fuel and food cost more. A weak economy does not become stronger because one line item in the inflation basket rises for a quarter. Europe is especially exposed in this setup because it may face both forces at once. It can face inflation pressure in the short run and growth pressure in the medium run. That is the kind of combination that confuses policymakers and punishes investors who wanted clean answers. If the euro weakens further, the dollar squeeze intensifies. If the dollar squeeze intensifies, the risk trade gets hit again. The cycle feeds on itself. You do not need every central banker to panic for that process to begin. You only need them to disappoint a crowded expectation. Crowded expectations break markets. That is the lesson buried under all the chart talk and all the headline references. The market does not need a surprise in the pure sense. It only needs an outcome that is less helpful than the crowd already priced in. Then there is the oil market itself. This transcript spends time on the Strategic Petroleum Reserve release and makes an important distinction. The release is slow, stretched over months. and in this case structured as an exchange that companies must return with extra barrels later as a premium. That detail matters because it implies two things at once. In the short run, it does not necessarily crush energy prices immediately. The pressure can remain. In the longer run, the willingness to borrow oil now and return it later suggests that companies may believe the future price will be lower than the present price by the time settlement matters. That creates the possibility of a future short oil opportunity after the panic phase. But that later opportunity does not solve the immediate problem. The immediate problem is that elevated energy prices can keep stressing Europe, keep muddying policy expectations, and keep feeding the stronger dollar story right now. I like that distinction because it prevents a common mistake. People confuse a long-term mean reversion idea with a short-term positioning event. Those are not the same trade. There may indeed come a moment when oil has gone too far, when fear is fully priced, when the release programs and falling demand set up a move the other way, but you do not earn the right to that trade by ignoring the current pressure. First, the existing imbalance has to play out. First, the crowd has to be forced through the narrow door. First, the dollar squeeze has to exhaust some of the people who believe they could live forever on the short side of the currency. Only after that do easier opportunities. Sometimes appear the geopolitical layer adds another source of persistence. Threats around transit, regional conflict, infrastructure vulnerability, and actual supply disruptions create the kind of uncertainty that keeps risk premiums elevated even when a government announces relief measures. The transcript also mentions shut-ins and storage problems, with millions of barrels affected and the possibility that turning production back on is not as simple as flipping a switch. That matters because markets often assume operational flexibility that does not exist in the real world. Once production is interrupted, logistics and timing matter. The problem can outlast the headline that caused it. Again, none of this requires apocalyptic forecasting. It only requires investors to stop treating the short dollar trade like free money. When I hear a market described as the largest short dollar trade in history, I do not immediately jump to prophecy. I do not need to. My first thought is simpler. If that statement is even directionally true, then the exit risk is large. Large crowded trades do not need total confirmation to become dangerous. They only need enough price movement to turn comfort into discomfort and discomfort into forced action. That is why I focus less on predicting the final destination and more on understanding the order of damage. First comes denial. People say the move is temporary, then comes trimming. They reduce some positions but keep the core narrative, then comes hedging. They try to offset risk while still hoping the original thesis survives, then comes abandonment. They sell what they once called conviction, then comes the public explanation. Analysts write elegant stories about a shift that had already happened. The market always writes the history after it collects the tuition. This source is already showing signs of the early stages of that process. Speculators are backing away from anti-dollar positions. Institutions are rotating toward safety. Asset managers are reducing futures length. ETF shorting is rising as people try to protect or express downside risk. Those are not random facts. They are footprints. They tell you the unwind is no longer merely hypothetical. Now, if I were speaking as a trader in the narrow sense, the action plan in the transcript is straightforward. Be long the dollar as the range threatens to break. Use 102 as a first waypoint, 104 as the next, and recognize that a move beyond that would indicate something more violent underway. On the equity side, consider short exposure or at minimum recognize that a stronger dollar can pressure the broad market. That is clear enough. But I have never thought like a pure trader. I think first about survival, flexibility, and optionality. So if I were applying the deeper lesson of this document to a portfolio, I would not present it as a heroic bet. I would present it as a reduction of vulnerability. If you are heavily exposed to a market that has enjoyed dollar weakness, and if the evidence says the dollar may be entering a squeeze, then it is sensible to cut some exposure before the crowd is forced to cut more. The transcript mentions trimming 10, 20, perhaps 30% of equity exposure. I think the spirit of that suggestion is more important than the exact number. You do not wait for perfect certainty. You reduce a position when the asymmetry is turned against you and when the thing financing your optimism is beginning to move the wrong way. That is not fear. That is discipline. People often confuse discipline with pessimism because discipline usually acts before the disaster looks obvious. By the time the disaster looks obvious, the price of discipline has gone up. The good decisions in markets rarely feel emotionally satisfying when you make them. They feel slightly premature. That is why most people do not make them. If you sell a little too early, you preserve capital and flexibility. If you sell too late in a crowded unwind, you preserve your opinion and lose your options. I know which one I prefer. Another idea I would emphasize is that holding dollars or dollar-linked safety in a moment like this is not only a hedge, it is dry powder. A stronger dollar hurts the people who funded risk with dollar weakness, but it also gives patience to the investor who did not. Cash is often mocked in the late stages of a bull move because it appears unproductive. Then a real liquidity event comes along and cash regains its dignity. It becomes not just a defensive asset, but the ability to choose. It lets you buy when others are selling because they must, not because they want to. That is where the real advantage appears. I never want to be the person who must act on somebody else's schedule. Crowded trades create forced schedules. The reason this piece matters is not that it promises a precise date for a crisis. The reason it matters is that it identifies a part of the market structure where compulsion may be building. Once you see where compulsion lives, you stop kidding yourself about liquidity. You stop assuming that everyone who wants to exit can exit neatly. You stop assuming that correlations will stay friendly. You stop treating the strongest move in the funding leg as an isolated event. This is especially important because many investors have grown used to a world in which weakness in the dollar felt almost helpful by default. It supported risk. It flattered foreign earnings. It made global liquidity feel comfortable. That memory conditions behavior. People keep doing what worked in the last phase of the cycle. They keep assuming the background conditions are stable enough for them to carry the same structures forward. But cycles change at the margin first. The old trade begins to fail before the crowd stops believing in it. That is why the best clues are often found where belief remains strongest. And the belief here has been very strong. The belief has been that the dollar would fade. The belief has been that policy easing would eventually validate the trade. The belief has been that Europe, whatever its problems, would avoid becoming the trigger. The belief has been that energy pressure was just another headline complication rather than the fuse under a positioning bomb. This document argues the opposite, and on that core point I think it is making the right challenge. The world may be much more exposed to a stronger dollar than equity investors want to admit. Not because the dollar is some mystical force, but because so many positions have been built with the opposite assumption embedded inside them. That is what creates pain. Pain in markets is rarely about a fact alone. It is about a fact colliding with a crowded position. A recession risk or even the shadow of a deeper financial event becomes more serious when it arrives in a market where institutions are already hedging, where asset managers are already cutting, where the currency leg is already turning, and where the policy hope that justified the trade is already fading. Add energy stress in Europe to that mix, and the ingredients become more combustible. I would also say this: a stronger dollar does not make the United States healthy by magic. It does not solve domestic weakness. It does not erase the risk that a higher energy burden can squeeze consumers here as well. The transcript is careful about that in its own way. The point is not that the American economy escapes pain. The point is that in a world where Europe may look weaker, where the Fed may stay firmer than expected, and where global investors need a haven while de-risking, the dollar can strengthen even while growth fears are rising. That combination is exactly why it becomes dangerous for other assets. People like clean narratives. They want a strong dollar to mean strength and a weak dollar to mean weakness. Reality does not always honor that preference. Sometimes the dollar rises because people are running from something else. Sometimes the dollar rises because the financing leg is being yanked back. Sometimes the dollar rises because a global crowd has to buy back what it sold short. Those are not celebratory moves. They are stress moves. Once you see them that way, the portfolio response becomes more logical. You do not chase every falling stock. You do not insist that the old winners must immediately bounce. You reduce exposure where the unwind can hurt you most. You hold more liquidity. You respect the currency move. You wait for the point where foreselling has created genuine value rather than simply more noise. That waiting is harder than it sounds. Most investors would rather look busy than be patient. But patience is only useful when it is funded. That is why flexibility matters. Now this transcript ends with a practical suggestion: hedge, cut back some exposure. Consider being long the dollar. Stay alert because the next week matters for policy communication and for how the energy story feeds into Europe and into the euro. I would phrase it in my own language, but I would not change the heart of it. Protect the portfolio before the crowd discovers that the world it was borrowing against has changed. There will be a time, if this process goes far enough, when panic creates bargains. There will be a time when shorts cover, when liquidations overshoot, when the market offers merchandise at a discount. There may even be a time when oil itself sets up attractively on the other side of an extreme. But those opportunities belong to the investor who comes into the storm with balance, not the one who enters it fully loaded on the wrong side of a crowded currency trade. That is the real lesson I take from this source. When everyone is talking about stocks, study the dollar. When everyone is admiring the asset, study the financing. When everyone is relying on central banks to make the trade easy, study the conditions that could keep them from doing it when everyone is short the same thing. Do not ask only whether they are right. Ask what happens if they are forced to move. That question has saved more money than clever forecasting ever will. And right now the answer is uncomfortable. If oil keeps the pressure on Europe, if the ECB cannot deliver the hawkish confidence traders had hoped for, if the Fed refuses to rescue the old narrative with the rate cuts the market wanted, and if the dollar keeps climbing through the very zone where investors have repeatedly leaned against it, then the unwind gets stronger. Each move higher in the dollar increases the pressure on the people who built their portfolios on the assumption of dollar weakness. Each act of covering feeds the next. Each sale done for risk control becomes a little more price insensitive. The stock market, which looked powerful while the dollar drifted lower, begins to feel heavy. What appeared to be diversification turns out to be the same bet wearing different clothes. I have never liked hidden sameness in portfolios. It is one of the costliest things in finance. A man thinks he owns 10 different ideas. Then one condition changes and all 10 decline together. He discovers too late that he did not own 10 ideas. He owned one idea repeated 10 times. A weak dollar supporting risk can become that kind of hidden sameness. That is why I would rather see the problem early and act, while action is still a choice. The public usually wants certainty before it moves. Markets usually punish that desire. So I would not wait for a speech to tell me what is already visible in the structure. I would not wait for every strategist to agree that the dollar squeeze is real. I would not wait for the market to explain the trap. After the trap is already sprung, I would look at the crowding. I would look at the euro. I would look at oil. I would look at the fading hope for easy Fed cuts. I would look at the shift in institutional behavior. And I would treat the stronger dollar, not as an isolated chart event, but as the pressure point that could unwind a much larger set of assumptions. That is how capital survives long enough to find the next bargain. And survival in moments like this is not a small goal. It is the whole game.